Hey everybody, welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group. Securities offered by MoneyBlock. Let's take a look at all of the action coming into today's midday. Currently, you're seeing that the NASDAQ Composite down 35 points at 5826.80. You see the Dow Jones Industrial down 20. It's been probably the strongest index out there right now, down trading at 20,817.30. You see the Russell 2000 right now trading at 1389.05, down 1095. We're going to watch this one very closely going into the close. And you have the S&P 500. The SPX is trading at 2364.36, down 545. You have volatility trading at 12.5, up 47 cents. Folks, volatility is on the move. Now, this is in front, of course, of President Trump's first address to Congress. And so today what I wanted to do in Strategy Now, take a look at the markets. We can see that there is a bit of a pullback going into this event. There's going to be probably a lot of sound bites that are going to be just torn to shreds and overanalyzed. But what I wanted to do was look at a strategic approach that we can take and utilize in environments where, yes, we have volatility on the move to the upside, but it's at 1256 on the VIX. This is historically very low. And so strategically, options are cheap. So what can I do to actually participate in this market? So there's going to be two stocks that are on the move that I'm going to take a look at and set up some trade ideas. And the specific trade idea two stocks I want to use are E-Trade Financial, ETFC, and Priceline Group. Two biggest reasons why I'm using these: they're in sectors that have been strong, finance and consumer discretionary, and they're on the move today. You have E-Trade after basic Fidelity and Schwab started a price war. They cut commissions down. So E-Trade's down 278, well off of its lows today at 34.42. And you have Priceline Group, came out, blew earnings away to the upside. Real positive in Priceline, trading at $17.37, up $104.86. Real big short squeeze going on in there. So what can we do in these stocks? Well, what I want to do is, first of all, jump in and take a look at the charts. And so what I'm looking at right here is E-Trade Financial. And what you will recognize right off the bat on this chart, it broke its 20 and 50-day moving average. Trading right here, right around that $34 level. This right here is support that it's had basically for almost the last year. And you can see at this $34 level, very critical right now that it holds this level. So if in fact you're bullish on the financials, you think that there's an opportunity after the stock has pulled off almost $3 from its recent close, but it has some short-term and mid-term bearishness, but you want to look for an opportunity to take advantage of maybe a pop over the next 45, 60, 90 days. What type of strategy can you implement? This is where I use calendar spreads. Now, what is a calendar spread? Well, a calendar spread, and ETFC, I'm going to go in, I'm going to do create my own. I'm here using the Trading Block virtual platform, and I'm going to scroll down. And what a calendar spread is, quite simply, where you're buying one option with the longer expiration. Let's say I'm going to look in July. So I'm going to look at the July expiration month. So I'm going to expand these. And I'm going to look at just slightly out of the money. So I'm going to look at the $35 call, right? Because I'm bullish over the intermediate to longer term. Okay, so I click that once. And as you know, if you watch my videos and you see my strategy videos, I am not a buyer of options unless I'm selling something against it. I never want to pay retail, as I call it, prices. So I'm going to sell an option, and one of my requirements is options. I like to sell roughly around between 40 and 50 days left to expiration. And since this is a calendar spread, I'm buying the $35 strike in July. So that's giving me time to rewrite. And I'm going to sell the same strike call, but with a shorter expiration month. And specifically, I'm going to sell the $35 calls. And do that. So if you scroll up, you'll actually see that I have this set up where I am buying the July $35 calls. So that's basically giving me right now about 4.5 months to be right. I'm selling the March. They expire on the 31st of March. So these are the, they're about 40, almost 50 days out till expiration, $35 calls. So this is the calendar, July and March. I'm doing same strike, so that's why it's a calendar, not a diagonal. Remember, we did poor man's cover calls last week. For those of you that are just seeing this for the first time, go back and check out Strategy Now last week where we did the diagonal spread, which is also called the poor man's cover call. I'm going to sell that against it to reduce my cost basis, and specifically you can see that this current spread right now is trading, I pay $2.47, collect 83 cents. So basically I can do this for right around $1.60. So if I actually scroll down, and I'm going to actually put in a limit price. I do not go to the market on spreads, and I'm paying a debit. So because I'm buying the longer term option, it has more time premium, and so it's more expensive, but it gives me more time to be right. And I'm going to pay, let's say I'm willing to pay $1.70, and I'm going to do that day order. I'm going to review this order. Obviously, I have to put quantity. So if each one of these contracts is costing $1.70, that's $170 worth of risk. I have basically a $25,000 account. Let's say that I wanted to put $500, or let's say about $700 to work, which is right around that 5% level of my total account value. I review the order, and basically, what are the profit and loss characteristics of this? Well, really what we want to do is we want the stock to get at $35 by March 31st. That is where our sweet spot is. You'll see that if you look at a risk graph, my thumbs are the break-even point, and you'll see the peak right here at $35. That's your max profit point. It's roughly around $39 to $40 per contract. So if I'm risking around $700, $750, I could potentially make $150. That's about a 25% return, not taking into consideration commissions. If I place this order, place it. Bottom line is, and you'll see that that was $600. I've now placed that order, and then I can manage it. I got filled at $1.70. So you're seeing now, if I go into my positions, and it should show up right here. Here we go. I actually bought it for $1.49, and you can see the prices, what I sold and what I bought. Now, when we go back and take a look at this, we'll manage this. So as we get closer to March expiration and we see that the stock is waffling between 33 and some change and 34, maybe getting up to that 35 level, we can take this off for a potential profit going into March expiration. If in fact the stock stays in this area between now and expiration, I'll just reduce my cost basis by 80 cents on the July contract, and I'll look to reinitiate a short option. Now remember, I sold that option for 80 cents. I will cover it at 40 and most likely roll it to the next expiration cycle. So if I sold March, I'll roll it into April. And do it on the next 45-day option or closest to, dependent upon when I get 50% of the total credit received. The next stock that I said I wanted to take a look at real quick is Priceline. Now, I did a bullish call calendar on E-Trade Financial, but as you could see, Priceline has run fast and furious to the upside today, up $100. Let's say that I'm not as bullish, or I see an opportunity like this where I want to sell into strength. It's clearly in a bullish trend after a consolidation, bounce off the 20-day moving average. So clearly it's overall in a short term and a long midterm as well as long term bullish trend to the upside. But let's say that we think that this gap right around that 1660, 1640 range it has an opportunity to maybe pull back there. What type of strategy can I do in Priceline to potentially take advantage of that? This is where I go back in, I go to trade, options, and I'm going to do a put calendar in Priceline. So PCLN, and you can see the quick search. I go create my own because I like to scroll down, take a look at this. I'm going to display the Greeks. And what I'm going to do is scroll down and take a look at the puts. Now you'll see that the puts over here, I'm going to actually contract this. Let's see. Now, I'm not going to go as far out. As a matter of fact, I'm probably going to stay in the May-April range. So I'm going to buy May. So I'm going to scroll down and take a look at the puts. Now, one thing you're going to see here, folks, is these are expensive, right? This stock moves. It moves a lot. It's a $1,700 stock, and with the $1,700 stock, it moved $100 today. So you can see that it's moving, and you can see that the bid-ask spreads are really wide. This may dissuade me from doing this particular strategy. But let's stick with example. I'm going to actually look at, let's just say for sake of example, I'm going to buy the stocks trading, let's just say the 1735 puts, and those are going to expire in May. And if I scroll over and down, I'm going to take a look at the April normal monthly expiration cycle, 35 puts. I'm going to sell those. Okay. Now, one thing that's notable here is that I am buying the May 1735 puts. I'm selling the April 1735 puts. I'm going to do one contract each. And you can scroll over and you can see that basically the debit that you are going to have to pay is going to be pretty significant. It's going to be about, and we could average this, we can just basically, you can see the bid-ask spreads. That's telling me that one thing that I gotta be very careful with my not only my position sizing, but my pricing on this. In other words, I'm going to put a limit price that I am comfortable with. If I am paying basically, it looks like I could get this done for around let's say $28 would be where I want to put this trade in. If I in fact trade this for $28, that means for every calendar contract that I put out there, I am risking $2,800 per contract. Now, that's over 10% of my account value. That could be too much for someone that is trading for the first time, or again, just trading in general. But because this is a smaller account, buying this calendar spread at a specific price, and you think that you're potentially getting short into strength, and that's where people like to do, let's review this order. I'm going to, at this juncture, just show you how you can participate in high flyers, and instead of having to put up an enormous amount of money to short outright a $1,700 put, or buy these puts, the May 1735 puts, which basically are cost about $7,000 a contract. I've cut that by 2/3 to $2,800 a contract, or $28 per calendar spread by the offset. And if I scroll down, I'm going to work this. Okay. And again, be disciplined. Don't move this around just so you can get this filled and figure out if you can make money. The current bid ask is $2,470, $2,890. Let's see if the market comes to me. I'm not going to move it. But you can see that basically right now, if in fact we start to get a pullback, and I probably should have done an out of the money. I know I did an at the money. I would prefer to do an out of the money. So you could actually scale this down to like the 1730, maybe even to the 1725 level. Pay about $1,000, which is about 5% of your portfolio. That would basically fit the profile from a risk-reward perspective. a lot better than putting 10%. This is a little bit more in the money. It could pick up an action. And again, what you're trying to do is just participate in the market to the downside without having as much capital risk as being in the outright position. In other words, in this case, short. As always, you can go and cancel and reset the order, reestablish it based on your risk parameters, your risk tolerances. And again, like I said, I might want to do a strike selection change. All right, folks, that is it right now from MarketStream on Strategy Now. We talked about calendar spreads. We talked about the market. Join us at 3:30 Eastern Time, where we're going to be talking about some earnings stocks in advance of President Trump's address to Congress. All right, we'll see you at 3:30 Eastern Time.